Well, after the mad flurry of the past couple of weeks, the reporting season ended this week, with investors left scratching their heads about what it all meant. So just what did happen and what broad investment themes emerged? I sought the opinion of the Chief Equity Strategist at UBS, David Cassidy. Well, David, how do you reflect on the profit season? Was it better or worse than you expected?
I think it was broadly in line with what we were expecting, Alan. We did see analyst numbers come down a little bit, but the market, I think, was expecting that, and we did see the market rally through the course of the month by about 2%. So I think certainly no worse than feared.
But there were some big differences between sectors, weren't there?
Oh, absolutely. I think what was most stark was the dichotomy between the resource sector and the rest of the market. We saw the resource sector generate earnings growth of around about 60% year on year, whereas the market, excluding resources, only saw earnings growth of around about 2%.
And within that 2%, were there some sectors going backwards?
Oh, absolutely. I think if you look at excluding the banks, you're talking about negative earnings growth year on year.
So the industrials, excluding the banks, went backwards?
Absolutely, yep.
So why was that? I mean, what's the theme that emerges from that?
Well, I think what you're seeing there is basically a couple of pretty important macro factors that are keeping a lid on profitability. I think the domestic economy over the past 6 months has been softer than expected and softer than trend. And at the same time, you've had a very strong currency. So both the domestic earners and foreign currency earners outside of the resource sector, things have been pretty tough.
But given the huge disparity between resources and industrials, is it valid to even talk about the market as a whole at the moment?
Well, I think what you would need to assume is we see some improvement in domestic economic conditions, and that's our expectation, and also at least a stabilisation of the currency. If we see those two factors, I think you can start to talk about a market that looks to be on the cheap side of fair value.
So can you explain how you conclude that?
Well, if you look at the market at the moment, both the market as a whole or excluding resources, the market's trading on about 12.4 times 1 year forward expectations in terms of a price-earnings ratio. That's well below long-term averages of about 14.5. So there's some latent value there. Just what's lacking at the moment is earnings momentum across a large portion of the market.
And what do you see as the main risks at the moment?
Well, I think the risks are obviously at the global level. The oil price is a key thing we're watching very closely. Obviously, inflation, more so in the emerging markets, particularly China, we're watching very closely. Then I think in terms of Australia, it really comes down to where the currency goes and what the RBA does or doesn't do over the next 6 to 9 months.
Well, speaking of that, what are you guys penciling in for rate increases this year?
Our central case expectation is that the Reserve Bank is on hold till around about August, where we expect a rate rise. So we think the RBA is currently in a holding pattern for some time now.
So are there any sectors that you'd steer right away from?
No, I think everything at the moment has both risks and opportunities. Clearly there's been a big variance in performance over 2010. It was really about resources and resource services. The rest of the market underperformed fairly significantly. So I think at the moment you've got a choice of continuing with the momentum in the resource sector or looking at some of the value situations in the rest of the market. So I think the whole market is fair game at the moment. Yeah,
it's not often you see something in it for everybody, like there's something for the momentum investors, which are the resources, and value investors, which are the industrials.
Yes, I think so. I think, even though the industrials are under pressure, if the earnings do start to improve, I think we could see interest return to that sector, quite quickly. And obviously M&A could be a factor that piques interest in that sector over the course of the next 6 months as well.
So to sum up, David, you reckon the market's a buy, right?
I think so. There's always risk, but I think we're on the cheap side of fair value, and we think that the profit climate can improve over the course of the year if the RBA sits back and does nothing for a period, and if the currency hopefully can at least track sideways or possibly a bit lower. I think that equities look relatively good value here.
Thanks for joining us, David.
Thank you.